The markets are now open and we can see a lot of red right across the board. Pretty much every industry is being affected. And when we take a look at the Fear and Greed Index, we're not only still in the extreme fear sentiment, but we're getting further and further towards the lower end. So no surprises, investors are clearly very worried, very bearish right across the board. And if we do zoom out and look over the last 5 days, while we can see some sectors, some companies have started to recover, we do also notice quite a lot are still suffering. Now the market has opened and we can see the Dow in fact is down 500 points, and one of the main reasons for this drop, if not the only one, are the Trump tariffs, which is causing a lot of confusion. And as we said, one thing the markets do not like is uncertainty, and that is what we have right now. We can also take a look at companies based on a forward valuation, and what we have started to notice as time has progressed over the last few weeks, companies are now starting to look a little bit more reasonably valued. We have Nvidia trading at just under 20, Alphabet at 17, Meta at 22, Microsoft at 26, so there are potentially some good opportunities now right across the board. And what we want to do today, in fact, we're going to look at 5 stocks with some massive upside in each one. We're going to give a quick spoiler alert. The first company has 96% upside. The second company that we're going to look at has 71%. The third company 67%. The fourth company 77%. And the final company we are looking at today will have 50% upside. So a lot of opportunities across all 5 stocks today. Jumping into the first one then, we have First Solar, which designs and manufactures solar panels, specializing in thin film photovoltaic PV technology, and the company focuses on utility scale solar power projects, providing sustainable energy solutions, and their panels are known for high efficiency, durability, and lower carbon footprints compared to the traditional silicon-based panels, and they also offer project development, construction, and finally maintenance services. So if we take a look, as we said, each one massive upside expected. Over the last year, they are down 18%. Year to date, they're also down 27%. But if you've been a shareholder over the last 5 years, you would be up 199%. Massive outperformance of the S&P, even right now with it trading at its 52-week low. Its 52-week high does sit quite some way above at $307, with both Wall Street and Seeking Alpha giving this a buy. But not only that, they're both not far off the 4.5 that would flip them into the strong buy rating. Now we're also going to cover the earnings of each one, and for FSLR, they anticipate over the next 4 quarters for each of them to be double-digit growth. However, word of warning, they have missed their most recent 2 earnings, and when we expand to the last 4 quarters, they do have a 50% track record. Having said that, based on their EPS estimate for the full year, if you do have faith they can hit that, they're trading at a valuation on a forward basis of 6.95. In terms of their gradings, they get an A+. Now what this means is effectively the sector does trade much higher at 22.7, so you are getting a 69% discount, but not just that, but also in relation to their own 5-year average at 20.66, this is trading 66% lower, something that we can see no matter what valuation metric you look at today. First Solar is trading at a significant discount to both sector as well as their own historical figures. Growth also looks very strong at an A, year on year 27%, forward looking 26%, well above the sector at the mid-single digit for both, and also well above their own 5-year at 11 and 12% respectively, whilst also anticipating growth to their earnings per share at 33% over the next 3 to 5 years, when the sector is a lot lower at 15, and also their own historicals sit lower at 22.5. So an A+ on valuation, an A on growth, but we do notice a C+ on profitability. Having said that though, gross margin still very strong at 44%, little bit below the sector at 50, but well above their 5-year at 26. Bottom line, net income 31%, sector at 4%, and over the last 5 years around 13.2. We also notice cash from operations 1.22 billion, well above the sector at 102 million, also well above their own 5-year at 519. And what we really want to make you understand in today's episode is that for First Solar, not only are they trading severely below their historical averages on a valuation basis, but their growth and their profitability does look a lot stronger. So while they're valued lower, their growth numbers are a lot better. They're growing their revenue at a faster rate, but also their margins are improving over time, so we are seeing efficiencies, and this is something that we would say does make us want to dive deeper. In terms of institutional ownership, 92%, 2.3 billion worth of sales over the last year, more than twice the amount of buying at 5.3 billion, and the same to be said in the most recent quarter, more buying, twice as much as selling, something consistently seen in 2024, so at least over the last year, institutions, and in fact in the most recent quarter, are very, very bullish on First Solar. Now, as we already highlighted, this first company has upside of 96%, and we do notice in our own intrinsic value, we get to $216. Now, typically on the channel, we do deep dives on each company on an individual basis. We run through every single model, inputs and outputs. Today, we're looking at 5, getting straight to them, 216. We always like to apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at $194, then we keep going till it's near the current trading price. And what we can in fact see, at the current value of $129, you're getting a 40% MOS. Wall Street, as we already highlighted, very, very bullish, a near strong buy rating. They see 96% upside with a $253 price target over the next year. And as always, give us your thoughts about these 5 stocks with massive returns. Buy, hold, or sell. Before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a copy of 32 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read these straight away. We then move on to Block, which was formerly Square, the fintech company that provides payment processing solution for businesses. They offer services like point of sale systems, cash app for peer-to-peer transactions, and Afterpay for buy now, pay later financing. And they also operate Spiral and TBD for Bitcoin development and decentralized finance. They also focus on financial inclusion and innovation in digital payments, and they're down around 18% over the last year. Year to date, down 30%, and if you've been a shareholder over the last 5 years, we can also see down 19%. Right now, similar to the previous company, trading near the 52-week low, and we can see 52-week high sitting around the $99 mark, with both, again, Seeking Alpha and Wall Street calling this company a buy. In terms of their earnings, over the next 4 quarters, they anticipate each one to be double-digit growth. However, again, very similar to the previous, they did miss their most 2 recent earnings, giving them a 50% track record, and right now, based on the EPS for December 2025, they're valued on a forward P of 13.55, which is actually higher than the sector median, so you are paying a 25% premium. However, do note, over the last 5 years, on average, their valuation has sat much higher at triple digits, meaning it's at an 88% discount right now, that you may come to a slightly different conclusion depending on which valuation metric you look at. For example, on a price to sales, they do trade at quite a significant discount, not just to their 5-year, but also to the sector median. In terms of growth, they get an A+, now year on year and forward looking in the 10% region, which is above the sector median in the mid-single digit, but we have noticed over the last 5 years, they have grown their top line at a much faster rate, around the 50% point. EPS looking good at 26% over the next 3 to 5 years, above the sector at 10, however slightly lower than their own historicals of 33.5. If we then move to profitability, they get a B. Now gross margin, 37%, that is lower than the sector at 60, but it is above their own 5-year. Bottom line, same to be said, 12%, lower than the sector at 22, but well above their 5-year, showing us good signs here of efficiencies, both on the gross and bottom line net income margin. Cash also generated from operations very significant at 1.7 billion. Sector sits at 146 million, and their own 5-year also sits lower at 539. In terms of the institutions, 71% ownership. Now they have been selling more than they have been buying at 923 million, with 626 in terms of purchases. However, what we have noticed in the most recent quarter, institutions were buying a lot more than they were selling, so they are more bullish, at least in the most recent period. Starting off with Wall Street then, their price target $101, giving this 71% upside over the next 12 months. Our intrinsic value is $79. Now we can quickly show you one model, so the DCF. Now what we effectively have is the free cash flow year on year. Now we have gone for a growth rate moving forwards of 8%, and we can in fact see a low, medium and high. Whilst these numbers are subjective and we have gone lower than analyst targets, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers where it is for XYZ or any others. But at 8% with a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $79, indicating 34% upside. But we can also show you for transparency at the 6% point, it does come to $69, 17% upside, and 10% for those that are a lot more optimistic, $91, 54%. Now taking through the median rate of 8%, as we typically do, with the margin of safety today for this company, we can in fact see you are getting around the 25% point. With Wall Street themselves, their price target is 71% upside, $101. Therefore, as we said, very bullish. They do believe this one, similar to the other companies we're running through today, are strong considerations for the portfolio. We then move on to Deckers, which designs, manufactures and sells footwear, apparel and accessories. They own popular brands like UGG, Light Hooker and Teva, catering to casual performance and outdoor markets, and they focus on innovation, comfort and sustainability in their products, selling through retail stores, e-commerce as well as wholesale channels worldwide. If we look at the company in terms of the performance, down 10% over the last year, year to date down 34%, losing 1/3 of their market cap. That is significant just in the 2 months. And then over the last 5 years, still with that drop, massive outperformance of the S&P, up 366%. Trading right there again towards the lower end of the 52-week range, with their 52-week high at $224, and we get another double buy from both Seeking Alpha as well as Wall Street. In terms of earnings, over the next 4 quarters, they expect 3 of them to be growth, with a 100% historical track record, and we can see their forward P right now does sit between 20 and 23. Given March 2025, their earnings is coming up very, very soon. Regardless though, in terms of comparison against the sector, they do trade at a premium, pretty much 46%, and in comparison to their last 5 years, they do at the moment sit a little bit lower, and that is something that is reinforced no matter what metric you look at today. For Deckers brands, we do notice quite a significant premium to the overall sector. In terms of growth, they get a B-, year on year 20%, forward-looking 15%, which is well above the sector at the low single digit, but also above their own 5-year average, even slightly at 17% and 13% respectively. EPS expected growth 17% over the next 3 to 5 years, well above the sector at 11% and slightly above their own historicals of 16.6%. If you look at profitability, they get an A, very nice margin at 58% when the sector comes in at 38%, but also above the 5-year at 53%. Bottom line, just under 20%, well above the sector at 4%, but also above their own 5-year at 15%. So we are seeing the continuation of efficiencies right across the margins. They also generate large cash from operations at $1.09 billion, when the sector sits much lower at $284 million, and their own 5-year sitting lower at $567. If we look at institutions, 98% ownership, $2 billion worth of sales, $10 billion worth of buying. So they've been buying 5 times as much just over the last 12 months, but also continuing that trend in the most recent quarter, so clearly very bullish. Then we get to the upside, as we mentioned at the beginning of the episode, 67%, and we do notice our intrinsic value at $229, again some nice MOS, and in fact as we do keep going, you are getting around 40% at $137, as we highlighted, a lot of upside. Again, let us know if this is one you are considering in your overall portfolio. We then move on to AppLovin, the tech company that provides software and AI-driven solutions for mobile app growth and monetization. They offer tools for user acquisition, in-app advertising and app analytics to developers, and they also operate a portfolio of mobile games through their studios and focusing on maximizing app revenue and engagement through their data-driven strategies. Now, if we look at the company's performance, they are up quite significantly over the last 12 months, 422%. Year to date, though, they are down around 8%, currently trading in the midpoint of the 52-week range, but their 52-week high is sitting substantially higher at $525, with Quant giving this a strong buy, a near perfect score, 4.99 out of 5, but Wall Street also giving this a buy at 4.32. If we look at their earnings, green right across the board, expecting strong growth to the EPS over the next 4 quarters, 100% track record, and it does currently trade at a valuation of 48. So probably no surprises to see it trades at a premium with the sector median at 23. You're paying around 75%, and we do also notice they are valued above their own 5-year by around 32%, something that we can see reinforced across both sector median and their own historical figures. In terms of growth though, A+, that is very strong and something that is needed if you are going to be trading at a valuation above the sector. 44% year on year, 29% over the next 12 months, well above the sector mid-single digit, but also well above their own 5-year at 31 and 22% respectively, and they anticipate EPS growth of 45%, which is well above the sector again at 15, and also well above their own historicals of 33.3. If we take a look at their profitability, again coming in very strong at an A+, gross margin 75%, well above the sector at 50, well above the 5-year at 64, bottom line 34%, well above the sector at 4, but also significantly above their 5-year. So again, like we mentioned for a previous stock today, they're growing at a faster rate than over the last 5 years, whilst also improving their margin efficiency. Cash from operations also looks very healthy at $2.1 billion, well above the sector at $101 million, but also above their own 5-year at $710. In terms of institutions, they hold 42% ownership. We see $17 billion worth of buys, around $11.5 billion worth of sales, but also the continuation in the most recent quarter, more buying than selling. Institutions again bullish on app loving. In terms of our intrinsic price, $396, as highlighted, massive upside. Wall Street anticipates 77%, their price target $540, and in fact you can see the growth rate we have gone for is 20%. Now what this essentially shows us is that using the higher rate at 25%, which we can show you today, does come to $558, 83% upside, and that isn't that far off Wall Street and their target. So analysts do see this company growing their free cash flows 25% over the longer term, and we've been a lot more conservative at the 20% point. And when we do use an MOS, you are still getting a margin of safety on the lower spectrum, 10% a buy at 356, at 20% 316, and right now we would say not at 25% just yet, sitting somewhere between 20 to 25, with, as we said, Wall Street incredibly bullish, 77% over the next year. We then move on to ConocoPhillips, the global energy company focused on oil and natural gas exploration, production as well as development, operating in major energy regions worldwide, utilizing advanced technology to extract resources efficiently. They emphasize sustainability, low carbon initiatives, and responsible energy production, and they generate their revenues through crude oil, natural gas, and natural gas liquid sales. Now they are down 20% over the last year, and year to date down 11%. Over the last 10 years, up only 45%. Again, this is if you had bought 10 years ago today. If, for example, you bought the COVID lows at around $27, you would be up nearly triple. And we can see trading right there again near the 52-week low, 52-week high, $135. A triple buy across all analysts seeking alpha, Wall Street and Quant. Wall Street and Quant, in fact, near enough the strong buy rating. And they are the first one today to pay a dividend, sitting around 3.96%. If we take a look at their earnings, again, bear in mind the industry they're in is cyclical, so we shouldn't be surprised to see 2 of the next 4 quarters being negative, but very good to see over the last 4 they have at least been in line or in fact outperformed, right now trading at a valuation of 10.83. If we look at valuation grading at a C-, we do actually notice it's trading at a little bit of a discount to the sector, 4%, but also at a 17% discount to their own 5-year average, which is always good to see. Their growth at a C+, year on year, -2%. Sector, a little bit better, +1. Over the last 5 years, though, a much higher rate at 22%. And over the next 12 months, 2.5%, pretty much in line with the sector. But again, over the last 5 years, they have grown a little bit quicker at 7.6. Over the next 3 to 5 years, though, they are anticipating EPS growth of 9%, above the sector at 8%, but also above their own historicals of 5.3. If we look at profitability, A+, gross margin 49%, above the sector at 46%, above their own 5-year of 47%, bottom line 16%, again above both sector at 10%, and their own historicals at 13.9%. Cash generated from operations is quite substantial at 20 billion, given the sector is much lower at 575, but their own 5-year is also lower at 17.03. If we take a look at institutional ownership, 82%, 7 billion worth of sales over the last year, 15 billion worth of buying, so a lot more buying. In fact, the same to be said in the most recent quarter. This company, COP, like the others today, institutions, clearly incredibly bullish. Now 50% upside, price target $132. We get to 131, not that far off. So you are getting a very nice margin of safety for a company where Wall Street does see a lot of upside. Not the 35% level just yet. You're getting at least 30% near $91. As we said, Wall Street 50% upside. And let us know with these 5 stocks, do you agree with Wall Street massive upside, or do you see them as a hold or potentially a sell? Don't forget as well to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon as well, where we do cover our weekly buys and sells. We have been buying given the volatility. And as always, have a great day. We'll see you all on the next one.